Ever wondered why a winning foreign stock can suddenly turn sour? It's all about currency swings. Learn how these FX fluctuations can make or break your returns. But don't worry, savvy investors have simple hedges to protect their gains. Watch the full video to discover how to turn currency risk into opportunity.
The other component that we need to look at is currencies, the US dollar and the like. And so one of the last topic here is the impact of currency moves on returns, people's portfolios. Selfishly speaking, I was going to get a PhD in currencies. So it was going to be currencies, rates, and commodities and how they intertwine and interlink, because a currency move is going to impact rates, is going to impact commodities, is going to shift the way things, what debt you're in, like what debt am I going to issue? Am I going to get access to new markets? Speaking of in the early 2010s, mid 2010s, when we took our rates to zero, people realized, or countries realized, hey, if I issue in dollar denominated debt, I get access to pension funds and 401ks and insurance companies because they don't have to worry about hedging. So when you look at this, how are these currencies going to impact returns? And is there a way people can protect themselves against some of these foreign exposures if they want to get involved in some of these great moves that are happening abroad?
So there is, but it's complicated. Let's start by talking about what the real issue is. So, there are all kinds of ways to invest. And as primarily US investors, most of us focus on US based stocks. And the truth is, the United States has the largest, most liquid capital markets in the world. And so it's easy to find attractive stocks at home. But there are times you might be interested in growth in another country, or particular stocks in another country, or maybe an ETF, an exchange traded fund that is a country index. And so, while that can create portfolio diversification and potentially put you in a position to benefit from faster growing markets or a faster growing company, it's important to note that those international returns are dependent not only on the performance of the individual company, but also on changes in the exchange rate of that company's currency. So exchange rates will move based on supply and demand, changes in interest rates, market interference by central banks. We've seen a lot of that. But it's really important to note that a change in the foreign exchange rate can move the positive returns of an investment in a foreign company negative. It can also go in the other direction. So the way to think about it is, if you invest internationally, you could win or lose in two different ways. There's the performance of the investment that you make, and then the performance of the currency. So, we saw that just a couple of years ago in Japan, a topic Mark and I have discussed at great length. And the Nikkei index, which is like the Japanese version of the S&P 500, just, an index that's supposed to capture Japanese industrial stock performance. The Nikkei was up a huge amount. And people were saying, wow, this is fantastic. We've gotten such great returns by investing in Japan. And the answer is, hold on a minute, because it took place during a time period when the yen fell from roughly 102 to the dollar to around, 140, 150, 160 to the dollar. So what happened was the increase in the Nikkei was up a huge amount, but once you adjusted for currency, your return in dollars was very unimpressive, depending on the time period you were looking at. And you think, wait a minute, how can an index go up 50% and I don't make money? The answer is because the yen fell by almost that amount, actually at times more than that amount, against the dollar. So the amount of dollars that you got for that increase in yen denominated Japanese stocks was negligible. It was very small. And a lot of people didn't realize that. So you have this risk. What do you do about it? You can either just take the currency risk and accept that these currencies will fluctuate, or you can try to hedge it. Now, hedging it would involve shorting that country's currency, the foreign country that you're investing in, through futures or shorting that country's bonds. But remember something, one, that's complicated. For something like that, you're going to need a prime brokerage account. These are things that are more difficult to do in like an E-Trade account or a Robinhood account or Schwab, something. It's not impossible, but it's more complicated. There's also an expense to it, and there's risk to it. We've seen situations where people have done that in Japan, and what happens? The Bank of Japan changes their rate, and all of a sudden, we've seen a massive increase in the 10-year rate on Japanese government bonds, right? And that market, by the way, is very thinly traded. It doesn't take a lot to move those bond positions. So there's risk either way. And I'm not saying don't take it. We're saying that the hedge can be expensive or cost you money. But if you're going to be investing internationally and you're doing something more sophisticated like that, these are the kinds of things you need to think about and potentially plan for to try to deal with those kinds of issues. Mark, you've invested internationally. What's your experience been?
You bring up great points, and that's where, and for anybody that's read the Wall Street Journal or heard, Bloomberg, CNBC, the carry trade, and that's when you think about what Gary's describing of you short one thing to buy another, that's the carry trade. You're protecting yourself, you're trying to guard against, but if things start to unwind, then you have to unwind the carry trade, and it's not just I'm selling stock or I'm buying something. You are unwinding the whole position, which is going to have many knock-on effects. And one of the things that has always been important is always evaluating the geopolitics, as we've talked so much about today, when you're investing abroad. And I look at generational dynamics. You start looking at where the investment is happening. And in the way that the Fed can try to create those opportunities, and you've probably heard this before, the Fed window or the Fed swap window, which can be opened to give countries or other central banks the ability to get dollars without having to worry about the flux or the adjustment in the currency markets, and try to create a direct line. But this is also where trade becomes so important, because a lot of these, if you look abroad, a large part of trade is in U.S. dollars. So if countries are not able to invest, or I should say export into the U.S., then they can't naturally take in U.S. dollars. So if they can't take in U.S. dollars, well, how are they going to finance their local debt or their U.S. dollar denominated debt? How are they going to stabilize their currency? Because a lot of these currencies are backed by either gold or treasuries or U.S. dollars to try to keep inflation expectations very, not to have a straight peg, but to have some sort of stability there. And if you can't get dollars naturally through trade, you then start to liquidate what is your reserve. And as you bring that reserve lower, the market gets more concerned, and then all of a sudden inflation starts to go up. You start to see these fears. The Turkish lira is at the lowest price it's ever been because of these uncertainties. And that makes Turkey very difficult to invest in, because where is the lira going? Is it going to exist? You look at South America. South America, their currencies have lived and died multiple times in the last 30 years, and it's because of that unknown, that uncertainty. And to Gary's point, when you look at Japan, sure, you may have on a paper done very well, but then when you go to realize that, it's like, oh, that wasn't that great, because that's in nominal terms versus what we call real terms. When you bring that and take that inflation or nominal rate away, and that's what you have to guard against. You want to be in those growth countries that are attracting capital, that are going to be in line with where you are. And to be fair, have some sort of hard asset. Is it a copper mine? Is it a gold mine? Is it a nickel mine? Is it something that is going to have a tangible value that will transcend what is happening within that country or the global fears in the market? And those are things to consider as you're investing, and not to get too specific about it, an ADR, which is a locally traded entity on the US stock exchange, but only has access or exposure to a specific region. And those are other opportunities as well. If you don't want to try to get into the hedging and the ISDAs and the prime brokers, because that is a huge cost that can also impact returns.
Yeah, that's expensive. And for people who aren't dealing with financial issues every day, when Mark's talking about an ADR, that stands for American Depository Receipt. It's simply a way of investing in a US brokerage account in assets that are overseas. It's a lot more simple than the terminology makes it seem.